This is Michael Reeder, CPA. Did you start a business since your last tax return? Let's talk tax implications. So first of all, the IRS puts the burden of tracking expenses on the taxpayer. So when you're a business owner, you have to track your business expenses. Are you tracking them on a spreadsheet? Are you tracking them on a bookkeeping platform like QuickBooks Online or Xero? That's Xero, Xero. That's another bookkeeping platform out there. You're going to want those expenses because those expenses are going to reduce your taxable income for your self-employed income. It's a plug right here for Intuit. I'm not making any money from Intuit, but my firm, we're big advocates of Intuit's QuickBooks Online platform. We're not fans of desktop. It feels like it just seems like QuickBooks Desktop is getting clunkier and clunkier as we move forward in the world. Here we are in 2024. And so we're big fans of QuickBooks Online. You might be in a certain business or like a franchise model, for example, that requires you to use like a certain bookkeeping system that is not QuickBooks Online. And so that's fine. But regardless of that, bookkeeping, tracking your expenses, tracking your income, having a bookkeeping platform. This is a major thing that now that you're starting a business, you have to think about this stuff when you're getting ready to file your taxes that you didn't have to think about before because you were just a W-2 employee and you weren't a business owner, but now you're a business owner. Well, how are you structured? Are you a sole proprietor? Are you an LLC? Are you an S corp? Are you a C corp? Are you a partnership? Is your head spinning right now with all of these different entity types? Now let's unpack the LLC. Okay, an LLC with one owner is a single member LLC, and a single member LLC is disregarded for tax purposes. And if you're a multi-member LLC, then you are by default taxed as a partnership. Are you a partner in a business or a shareholder in an S corp, for example? And the other partner, the other owner, like they are preparing the business tax return for the S corp or the partnership, and they're going to give you what's known as a K1. So a K1 is a form that you have to get once the S corp. It only applies to, in this context, it only applies to S corporations and partnerships. It also applies to fiduciary income tax returns as well, potentially, but we're not talking about that here. But if you are a part owner in an S corp or a partnership, and the other owner or partner is preparing the business tax return, then you have to say, "Hey, what's up with my K1? Is it ready yet? Because I gotta prepare my personal taxes." So this thing called a K1, it may apply to you if you are either fully or partial owner in an S corp or a partnership, and who's preparing the S corp or partnership tax return? Is it your CPA? Or is it your other partner's CPA or enrolled agent or tax preparer, et cetera? So think about that as well. So these are things to think about when you're starting a business. Have a question? Reach out to me and my Reeder CPA Group team to learn more.